After having done the chapter on the unit on ABC, activity based costing, now we proceed to another area which is very important and pertinent to the practical world. It is called target costing. When I put star, this means this is also appearing in your exam on certain frequency. It is said Rome was not built in a day. This proverb, when you apply to your preparation towards CA final examination course, you need to continue your effort on a systematic basis. You must learn on regular basis. Chandiok Adaptive has made its software which allows you to prepare your study planner. It allows you to structure based on number of video hours the various chapters and the topics included therein, so that you can gradually prepare all the 4 subjects of a given group. Friends, it is not the subject which will pass you, it is the group which will pass you, and to get success, all the 4 subjects must be studied on a regular basis. It's just like school preparation. Remember, in school you were doing all the subjects together as per a schedule. This schedule is very much required to get success. So there is a need of parallel study of all the subjects of a given group together. The subject may pass you, but group won't, because ICI says you must get 40 in each subject, but on aggregate basis 50% you have to secure in all the subjects of the group. The same holds true for both group also, friend. So we start our discussion on target costing. So what is target costing? The word target emphasizes a goal. So this costing mechanism works backward. So take one example. I go to market and see one camera. The camera is a Chinese camera and is priced at $150. This camera, if I have to build up, being a camera company in India, what I will do? Think. First of all, I will take $150 as the base and find out our profit margin. Suppose we decide 20% margin, which is $30. This means within $120, I must incur all my cost, which is cost of material, cost of labor, cost of overhead. So all cost must be budgeted within $120. This is target costing. The current practice is you do your costing, add your profit margin and arrive at a price. Here we are reversing the process. So the process is what your competitor is charging. First determine that. Reduce the profit margin you want to take and balance what is left becomes the cost of budgeted resources, be it material, be it labor, be it overhead. So, target costing is a value improvement tool which aims to enhance the quality of the product. So, as a Indian cameraman company, as an India camera producing company, you would prefer to provide more design specification better than what is prevailing in the Chinese camera. Maybe you come out some unique 2-3 features which becomes an innovative thing in the market. So this is how the products compete globally. They are applying target costing. Let us see how. So first of all, they explore features and pricing of mobile phone competitors, right? So this is the first step they do. You can say they do research and development, and they arrive a better quality. Quality can be in terms of features, or it can be in terms of design, or it can be in terms of functionality, right? So they tell what is the pricing of a better model. I can say a word, revised model. So this is reduced by margin of profit which business desires. So this gives me cost of production. So I am in a position to decide my mobile phone will cost this much per unit, and we break up in terms of direct material, direct labor, variable overhead, and to an extent new fixed overhead which is used in producing this material, this finished product in the market. Now what we do, we try to find substitute, and we may think whether we make or outsource or buy from the market. So this is the management's constant process which they may look into. They may prepare some of the element in-house or outsource something from the market. In case of labor, they come with a new comprehensive rate where they ask for efficiency and pay the top performer in terms of bonus, in terms of other criteria. They use the concept of activity based costing where they create the primary activity and secondary activity. They determine the cost driver, and the total quality management process is put into the practice in the shape of better design, which we have spoken. Better design means better process. So this is how the business is working to create a target cost of production. So this cost of production is basically target oriented. What is the target? The target is to give better feature functionality, better design, and ultimately a revised price. So this is what the management is contemplating, and this is a ever evolving process, a continuous process. So you have continuous process which is working on quality parameter. So friend, this is how this target costing works. So in the exam, if you get a short notes, this is an area which you must emphasize. Now you can say this target costing ultimately looks the customer's pricing ability. It works on the parameter what customer can pay. From that customer's payment criteria, you reduce the margin of profit which you expect, and then you decide what will be the cost of the budgeted resources which you are using in the business. So this is how it works. Now we will do certain practical questions in target costing. So let's start doing numerical questions with me. So question number 1 is something which explains that target costing is what all about we have discussed now. So the question says a company has production capacity of 80,000 units of an electronic spare part and presently sells 20,000 units at rupees 100 each. So I just write down the informations provided. Selling units 20,000 and the selling price per unit is rupees 100. Now the question further says that the demand is sensitive to the selling price. Very important line, which means if you change demand, the price changes. It further says it is noticed that every reduction of rupees 10 in selling price makes demand double. So every reduction in selling price by rupees 10 makes demand double. So this is the next critical line which is highlighted in the question. Further it says what should be the target cost at full capacity if profit margin is taken as 25% of the sale. So they want target cost when profit margin on sales is 25% of selling price. So this is one part of the question. The second part of the question says what should be cost reduction scheme if at present 40% of cost is variable with same percentage of profit. So they are asking that cost reduction scheme. So ultimately they are asking what should be the cost reduction scheme which allow variable cost to be at 40% of cost and same percentage of profit. It is given rate of return is 15%, And further it asks what is maximum investment which can be done at maximum capacity. So this is a question which has appeared in your examination. So friend, I am going to start the working note, and on the next sheet after doing the working note you will have the complete solution. So let's do working note with me. So working note is following. So what is for A part? What is the maximum capacity? If you see, the maximum capacity, the question says is 80,000 units. So you can even write here maximum capacity is 80,000 units. So what I have written down here is basically I have marked the important points given in the question which is coming in your pop-up, right? So maximum capacity is 80,000 units, right? What is the present capacity? The present capacity is 20,000 units. So the present capacity is 20,000 units at rupees 100 per unit. Now, if you have to increase the capacity, this means you are going to reduce the selling price per unit. So, selling price per unit can be represented in a tabular shape with the demand. And the crucial line is every reduction in selling price by rupees 10 makes demand double. So, for 100 rupees selling price, the demand is 20,000. For 90 rupees, which is 10 rupees less, the demand will become double, 40,000 units. For 80 rupees, the demand will become 80,000. So this is my full capacity. This means I can keep the selling price at rupees 80 so that I reach to my full capacity where I can produce 80,000 units. So friend, with this information on the working note, we proceed to the next page. After having obtained the quantity and the price, the quantity at maximum capacity level equivalent to 80,000 units and corresponding price of rupees 80, we decide what is the profit margin we are going to keep. So the profit margin is 25% on selling price. This means 20 rupees is my profit margin, 25% of 80. So I am left with rupees 60 per unit as cost of budgeted resources for which I have to use for this numerical. So your target price is rupees 80 and target cost is rupees 80 minus 25% of rupees 80, that is rupees 60 per unit, right? So the total target cost, so this is what I have got is in terms of per unit. Now I will work out the target cost on total basis. So the total target cost is for equivalent unit. This is 80,000 units for rupees 60 per unit. So this works out to rupees 48 lakhs. So this is the first part of the solution.